Since January the 1st, 1872 to the end of last year, the return of equities, of shares, of the US stock market was just over 9%.
It doesn't have to take 40 years. I mean, I think it does have to take 10, 15 or 20 years, unless you're earning an enormous amount of money.
My genuine belief is that reality is nothing less than a tragedy. And it's part of why we have a cost of living crisis. It's part of why the economy is so challenged. It's part of why the government can't fund the NHS, because we're not creating real wealth.
Andrew, welcome back to the show. So good to have you again.
Thank you very much. It's excellent to be back. It's been a while since the last one.
Yes, it's been a long time, and I don't want you to do that British thing of being modest, but I've told you before that our recording almost 3 years ago now, episode 42, has had a massive impact on my listenership. It's had a huge impact on people that have messaged me about investing for the first time, about understanding investing for the first time, and maybe not falling down some of the potential rabbit holes that they might have done, given how seductive some of the different things that have happened over the last couple of years when it comes to finance have been. So please do take the praise sincerely when I say it's been a massively impactful episode. And we've joked before that your audience isn't massive on social media, but the episode itself stands up against some of the huge names that I've had on that have massive followings because of the value that was within the episode itself.
Well, I will be British, but nevertheless, thank you very much. And it never gets old. I mean, I still get lovely emails from people, probably at least a few times a month, kind of saying how much they enjoyed the book, or how helpful they found the book, or even that it was life-changing, whatever else. And to be honest, given what the work required to write a book, that's kind of those comments make it all worthwhile. Having just written another book in the last 2 years, I'm hoping that the same happens in the next few years with that book, because it's a bit of a nightmare getting one over the line, to be honest.
It keeps you going, and while you're not doing it for the validation, it's just reinforcing that you're having a positive impact, which, as we'll definitely touch on with your upcoming book, How to Own the World, certainly had that for such a large number of people and such a cohort of people, because it was that whole stick of plain English finance. You spoke to people in a language that they could understand, that they could action, rather than maybe some of the isolating terms that are typically associated around finance, particularly when it comes to investing for yourself for the first time and all the different pitfalls that you can fall into. So I think it's a welcome antidote to some of the challenges that we have in modern society.
Well, thank you very much. That was the intention, and it's nice to know that I got there at least with some of the audience in a small way.
Yeah, exactly that, Andrew. But you were talking about the nature of the economic environment, some of the fiscal policy that's been going on, and almost an element of this is the current environment that we're experiencing has been coming down the tracks for a number of years, just based on where we've been heading. I know you probably don't feel this way, but is there an element of I told you so when it comes to some of the things that we're seeing when it comes to the economy?
Well, I mean, nobody likes a smart ass, right? And you don't want to be smug. And I think the key thing is that everything I set out in that book, for example, about inflation, the idea that inflation is kind of always and everywhere higher than people really understand it to be, because of the machinations of what the various government agencies that calculate and produce it, because of what they do. There's a famous American hedge fund manager who describes the calculation of inflation as being cooked like a Thanksgiving turkey, which is a very sort of American version of the point. But broadly, it's in the interests of public sector institutions and government to represent inflation as being lower than it actually probably is in the experience of real people. And I obviously set out in the book how they do that. And I'm absolutely not the only person who's kind of pointing a finger at that reality. But I guess the fact that cost of living crisis we're going through now, and it's all come home to roost, I mean, this is all part and parcel of the same thing the same points I made in that book. And I guess that having been said, I wouldn't wish the current situation on anyone, and one of the other things I talk about in the book is this idea of money illusion. Is that, even with inflation at 3 or 4%, the impact that has on your ability to generate wealth and keep wealth and make forward progress in real terms financially is really quite significant, let alone with inflation at kind of 10%, right? And at the end of the day, it's really important when people think about investment returns, interest rates, whatever else, they're thinking about real, not nominal. So if inflation, if interest rates are 2% and inflation's 10%, you're going backwards by 8% a year. And 8% a year over a few years will basically halve, in real terms, what you have in terms of investment. So yeah, I mean, sorry, it's a bit of a long answer, but you don't want to be smug about stuff. I think the picture I painted in the book was readily available from lots of people far smarter than I am, and I hope that the people who perhaps took on board some of those ideas will have done better than people who perhaps haven't. And I mean, if I may, I mean, one of the key arguments in an era, in a time of high inflation, it's absolutely critical to be investing in things that will outperform inflation and create a real forward trajectory in terms of your growth of your wealth. And that is a point that's just super important for everyone, because the worst possible thing, one of the biggest things we confront nowadays is people fear investment. I was writing a piece actually earlier, like this morning and yesterday. Only 5% of British adults have a stocks and shares ISA. So that basically means that only 5% of British adults, 95% or so of British adults, are not knowingly and proactively investing in the stock market. They might have some equities, some stock market investments in their pension. Most people will have no idea, like how many or what they are, or they're American or Asian or whatever else. But if you look at just the number of people who have ISA accounts, only 5% of British adults are knowingly, proactively saying, I want to open a stocks and shares ISA. And that, with inflation at 10%, if you're not investing in shares and equities in the stock market, you've got no hope of making any forward progress in terms of growing your wealth, right? So I think that's a really
that is a remarkable stat, Andrew. I had no idea that it was so low, and I guess we are in a little bit of a bubble considering all the different finances episodes that I've done off the back of our initial one back in November 2020. I've had a lot of different financial guests on the show, and my audience have not had it rammed down their throat, but they've had that shared with them to explore that topic. So maybe we are very much in a bubble of people that are considering these things.
The sort of people who watch podcasts like this obviously distinguish themselves in a tiny minority or a very small minority of the population, right? Which is part of our mission. I mean, it's genuinely. I described it. I'm sending an email out on Thursday to our audience, assuming it makes it through the edit and whatever else, but hopefully. And my genuine belief is that reality is nothing less than a tragedy, and it's part of why we have a cost of living crisis. It's part of why the economy is so challenged. It's part of why the government can't fund the NHS, because we're not creating real wealth. We need to have an equity culture. And part of the reason that Britain was one of the preeminent economies of the world is because we and the Dutch invented the stock market as a technology, because that's ultimately all the stock market is a technology. Niall Ferguson, the Harvard economic historian professor at Harvard, who's a brilliant guy, describes basically sort of property markets, financial markets, capital markets as one of the killer apps of modernity. And that's what it is. It's a technology that allows our species, if you like, it sounds slightly hyperbolic, but to pool risk and syndicate risk. And when, if you think about the voyages of discovery in kind of 1600, even royal families couldn't actually afford to equip and fund like a flotilla of boats to go to the East Indies or out there in the rest of the world to go and get spice and I mean, this is ultimately where it all came from. And so some brilliant guys in Amsterdam and Rotterdam in like the 1600 whatever, the early 1600s, and then latterly in the coffee shops of London in the late 1600s, came up with this idea of just sort of issuing pieces of paper that said, if you stump up 1% of this sea voyage, you can have 1% of whatever the upside is from that. Now, that's how the stock market came about. And without the stock market, you wouldn't have aeroplanes, large buildings, ships, football teams. I mean, seriously, it's one of the underpinning, the most important killer apps of modernity and post-modernity. And it is a tragedy that people too few people in our society know that, think about it. They think about it as risky and for rich people, and that's just so wrong, right?
Tragedy was the immediate term that came to mind because, as you said, it's been a massive driver of human progress throughout this period and all the different upsides that have come off the back of it. And that's one of the kind of key themes of positivity that you bring to this space, Andrew, because you're saying there the stock market has its virtues, whereas in an era where we do suffer from crony capitalism, and I'm sure we'll talk about that as the conversation goes, people immediately lump in all these different private companies under one banner of like, oh, wealth is evil and the investing in things is for rich people, as you said, and they isolate themselves from that. But ultimately, investing in these companies is vitally important for the future of humanity in the direction that we want to travel in. And I know there's particular sectors that you're particularly bullish and excited about as well. But I guess it's almost like in defense of the stock market, you need to understand the the downstream effects for wider society in the small actions that we're taking in terms of investing with the stocks and shares as a listener to a podcast like this one.
Yeah, and I think if you, my fundamental position is that modernity has been a good thing, right? So basically, if you compare the lives of the average person today, and even in the developing world, not sort of obviously in the rich developed world, in the UK and Scandinavia and Australia and America or Switzerland, whatever, but even in Nigeria and Indonesia and, most obviously in places like Singapore, the Asian tiger economy, South Korea, at the end of the Second World War, South Korea was an incredibly impoverished, backward third world country, basically. And today it's a fabulous, modern, technologically advanced economy where GDP per capita is on a par with Switzerland, right? But the broader point is, wherever you go in the world today, we have factually, much longer lives with better healthcare, we're more leisured. The fruits of modernity are extraordinary, as against, if you put either of us in a time machine and send us back to 1900 London, or certainly 1800 London, or 1700 London, or 1600 London, or wherever else, Glasgow, the world, life was grindingly frightening and impoverished and poor, and you couldn't go and watch a football team at the weekend in a massive stadium, you couldn't go to a beach bar and on holiday in the Mediterranean somewhere, even if you're actually from a relatively kind of lower middle class background, you could afford foreign holidays. And we, because of a psychological bias called hedonic adjustment, humans are unbelievably good at adjusting to a new reality. So that's bad if it's an amazing new thing, like the fact that most children don't die from of an infectious disease by the age of 5, and most women are relatively safe having a baby, right? Whereas 100 years ago that wasn't true. So these incredible developments, thanks to technology and innovation, and frankly, with as hyperbolic as it sounds, the stock market, right? Because it provided the capital for all of that technological development to occur, to pool capital and syndicate risk. And I think we very severely kind of underestimate all of those benefits because of hedonic adaptation. So we adapt very quickly to something like a smartphone. A smartphone is unbelievable. And if you gave it to somebody in 1980, let alone 1920, they'd say, what, you can talk for free to your mate in Australia for what? I mean, this, even when I was at university, that would have been remarkable. But the other thing we do, the good side of hedonic adjustment is it means, so Viktor Frankl, for example, wrote an amazing book, Man's Search for Meaning, an Austrian psychologist who spent time in Auschwitz and various other concentration camps, possibly the worst human experience that anyone could have had. And the upside of hedonic adoption, which is probably why we have it, is that human beings are also very good at adjusting to bad situations and it becoming kind of the norm. But what it means is, to come back to the kind of broad point, is we are terrible as a society at celebrating, and what we do is we take for granted what capitalism, democracy, financial institutions, financial markets have given us as a species, which is an unbelievable uplift in the human experience in terms of all the things that actually matter in the last century or two. And we're achieving that whilst only 5% of British adults are investing in the stock market. Imagine what we could achieve if 50% or 90% of British adults are
if we can move the dial in the right direction, it could be even more capital. That's
right. And I feel this particularly acutely, having just spent 8 years predominantly focused on life sciences and biotech companies, right? Because biotech, when most people hear the word biotech, they think about therapeutics, like cutting edge science that's maybe going to try cure cancer or dementia or obesity or autism or whatever else. But actually, if you like, the last century's been about tech, right? And automotive, aviation, silicon, smartphones, internet, AI, machine learning. The next century is going to be about biotech, because most of our intractable problems as a species concern biological systems. So it's a lot more to do. It's not just kind of curing cancer. It's about rolling back environmental degradation. So bioremediation technologies, massively improving how we go about making food, like agriculture generally. You can apply biotechnologies to clean power generation, like photovoltaic cells with biofilm coatings, and so I think that if you like, the capital required for all of those amazing technologies to deliver yet more uplift in the human experience needs to come from the stock market. And just to so I can get it in, sorry, I'm rambling away, but the final point is that I've lost my thread. Sorry.
No,
I don't know. The final,
and
yeah, the final point. I've got my thread back. The final point is, of course, the big counter argument to all of everything I've just said is, but environmental degradation, right? But global warming. Yes, most billions of people in the world today have like TVs and smartphones and go on holiday abroad, and life is immeasurably better for us than it was for somebody in every other age of man. And by the way, your risk of dying either from just local violence or in war today, notwithstanding the Ukraine and Yemen and certain horrendous areas of the world, as a species, you've never had a lower risk of kind of homicide or genocide, which is another remarkable fruit of modernity and capitalism. But the counter argument is, okay, well, it's great for us, but it's not so great for the massive raft of species that are currently enduring extinction, right? Or the fact that rivers are polluted and seas are polluted and fish stocks are falling and, and all of that stuff. But I guess this is a key quest of mine, is the solution for all of that will come from capitalistic institutions, right? Will come from innovation, and particularly biotechnology, as I was just saying earlier, because biotech can and is already addressing these problems in a remarkable way. And sadly, because
it's those companies that are doing the research, as you said, that are moving us towards these different solutions, which are going to tackle quality of life, but also the quality of the environment and the longevity of the planet alongside that. And I guess to hark back that hedonic adaptation piece, I completely agree. From an evolutionary perspective, Viktor Frankl is like one of the extreme examples of somebody that can find the benefit from even the most difficult situations. He can create meaning for himself and create enough willpower to move on and continue. But it means that we do have this massive negativity bias towards almost all situations. Absolutely. And we really, really have to work to counteract that. And as much as possible, somebody like yourself bringing positivity about the economic environment. And one of the big pieces of positivity that I will always try and bring to the podcast is simply by opting in to start with, to listen to something like this on a weekly basis and learn from experts like yourself that I bring on. You're giving yourself the opportunity to take action that will separate you from the herd, so to speak, or the people that are suffering, that 95% of people in the UK that are completely oblivious to investment and the opportunities within that.
And massively to their detriment, right? Because investment is a silver bullet for the individual, because it means you are much more likely to become wealthy. Therefore, you can support you and yours. That's really good for the government, because it means fewer people need to be on benefit and being supported by the government, because they and their dependents don't need government help. But most importantly, investors provide the capital for capitalistic companies to do incredible things, which in the past might have been a smartphone or a supercomputer or AI or whatever. And I think in the future will be if every country in the world was agriculturally as productive as Holland, we would not. There would be no world hunger, right? But unfortunately, India and Indonesia and Pakistan and Paraguay and wherever else have immeasurably less efficient agricultural productivity, and the biotech industry is going to solve that. But the companies that are innovating in that area need capital to fund it.
Completely agree, Andrew. And I guess, again, like a quote that I wrote down in advance of this was that pessimists sound smart, optimists make money.
That's the title. That is the title of the email I'm publishing on Thursday for our audience, annoyingly enough.
Brilliant, Andrew. Spoiler alert. But I certainly believe that. And while I think if you looked at my worldview and probably yours, given the conversations that we've had previously, we're very realistic about what the overall environment is. But you have to be optimistic from a personal point of view about the choices that you can take with information that you gather to put yourself in the best possible position. Because you've recently been on Damien Jordan's Damien Talks Money podcast, and I've had Damien on the show, and he joked in our conversation that Michael Burry has predicted 11 of the last 2 crashes because he constantly...
Paul Samuelson, who I think is a Nobel Prize winning economist, said exactly that. Like, economists have predicted 9 of the last 2 massive stock market crashes or whatever. It's 100%.
Because he just errs on the side of negativity at all times. Now, don't get me wrong, he was completely correct in 2008 about what was going on with the housing market in America. And while he's made some notable predictions coming up now that may well come true, he's constantly shouting that it's going to go to hell. And Damien and I said, if you throw enough shit at a wall, some of it will stick. And we used that as a clip for TikTok, and of course got people shouting and arguing, but that's just the nature of the internet. And it was very interesting to see him say, well, if you are truly believing that the world's going to hell in a handbasket, you are betting against human progress. And
you need to get hold of some guns, buy a ranch with fresh water and 100 head of cattle and a fishing boat and a stock of fish. And ultimately, if the world is going to go like into sort of post-Armageddon nuclear, Putin, Ukraine, it all goes wrong, your investment, you might as well have been investing along the way and being bullish, right, before that happens. Because, and actually, this is perhaps slightly controversial, but if you were Jewish and living in Vienna in the 30s and investing and wealthy enough to take a view that, look what's happening with Hitler, I'm leaving, you had the power and the freedom to do it. So actually, but whatever, if circumstances become really awful, the people who've invested and accrued capital have more power to go and buy, sorry, slightly spurious. The other thing, just quickly on that point though, because in this email I'm writing, pessimists sound smart, optimists make money. Just to take a step back, I open it by making the point that in the century from January 1923 till December 2022, sorry. So basically in the last century up to December just gone behind us, the S&P 500 returned more than 10% per annum, annualized, right? And it's something like 7.25% real return after inflation. So to think about how many times in that century, like Second World War, Korea, Vietnam, Cuban Missiles Crisis, oil shocks in the 70s, there's always bad news that you can alight on and go, oh, the world's coming an awful place. But in that century, you would have made 10% nominal returns, 7.25% net real returns after inflation. That's enough to make a normal person a millionaire, right? And in the UK, in the 66 years from 1955, when the index was first created, to the end of 2021, which is when I've got the research from, but it's broadly going to be the same number. UK smaller companies, so the smallest companies in the London stock market, returned 16.4% per annum, which, by the way, is 4 times the return on UK house prices in the same time frame. So everyone's like, property is the best investment, house prices from 1955, isn't that great? You can borrow money to invest in houses, which is a big advantage if the market's going in the right direction. Most people can't borrow money to invest in UK smaller company equities. But that's why optimists make money. Because if you zoom out and ignore all this news and Ukraine and whatever else happens to be prevalent in the news today, the long run return of equities means out to about 10%, and the long run return on sort of, if you like, slightly more sex and violence, volatile equities like smaller companies or biotech or tech or whatever, probably comes out of the wash at, somewhere between 12 and 15%. The tragedy is that a vanishingly few people, 5% of people who have got a stocks and shares ISA account, a tiny percentage of them know what I just said, because most of them have just invested in a thing that their mates, you know what I mean? Like, they haven't really gone down the rabbit hole on what I just said. Although, that sounds immensely disparaging but I think it's true.
I think it's a fair comment, and the data backs it up. And at the time of recording, my Vanguard is about 7% down. Now, that's not a nice figure to look at, but I'm not looking at it on I think I've probably been investing for about 5 or 6 years now. So I'm not looking at it on purely a short-term horizon. I need to look at the longer term. So if I stay calm and I look at the price that I'm buying things at each month when my direct debit comes out in 2023, best believe that will probably look pretty good in terms of a number in 2050 or 2060, and that's the plan.
But that's why we often say that admin is 90% of investments success, right? Fund selection or asset selection is like 10%. And the reason that's true is because if you regularly invest in something sensible without fail every month, from the time you can first do that, because even if you've got even if you're like in your 20s and you're working in a bar and you've just come out of uni and you haven't yet got your first job, and you put 25 quid a month in, which is basically what most of the big investment platforms in the UK will let you put into an ISA, right? The minimum 25 quid a month or thereabouts. Because what you just said, so you're down 7%, but the fact that you've had a monthly savings and investment habit means that you've still got quite a lot of, how many thousands or tens of, or whatever it is, of pounds there that just happens to be down 7% at the moment. But it's how many thousands of pounds more that you would have had you never developed a savings and investment habit and just spent it in the pub or on a car or on a holiday or on a whatever, And so this is the key thing, is that if you can save and invest every month without fail as a life habit by direct debit, as you just said, you're going to pound cost average into human progress. If you're investing in basically equities, and if you do that over 20, it's something like you've got a 95% chance of being up after 5 years. And that moves towards a 99 to 100% chance of being up after 10 years, 15 years, 20 years. And if you're lucky, you'll have, if you're one of the lucky people, you'll have started investing in like 99, 2000. And by now you'll be up ridiculous, right? Your annualized returns will be 12, 13% or whatever that implies from if you've been lucky enough to start investing at the lows. But the mere fact that you have a monthly savings investment habit means you're accruing capital, whatever the performance numbers are. And in the fullness of time, the performance numbers should deliver an awful lot more in the compounding and everything else, for sure.
It's very exciting. At this period in time, though, Andrew, there's a lot of different distractions, and I know you're rallying against some of those because that might actually challenge our ability to progress as a society. And I know that the stock market has numerous different challenges within that. What are the main ones that you've identified that you believe we need to become more aware of?
Well, particularly, let's be a bit UK focused, because I appreciate your audience is probably quite a global audience, but we're sitting here in the UK, and presumably the majority of them in the UK. The stock market, the London stock market, has lost more than 1,000 companies since 2007. So in Q4 2007, there were 3,250 companies listed on the London stock market. Today, there's something, I think it's 1,927, or last time it was 1,940, something like that, sub 2,000. And it's a great kind of untold story. And actually, the Chancellor, Jeremy Hunt, did a presentation last night at Mansion House and starting to unpack some of these ideas. And Her Majesty's Treasury, the FCA and the government are beginning to, it appears they're beginning to kind of identify the fact that there is a problem, because they've been very ostrich and la for a long time now. If you ask anybody who's worked in smaller company equities in London for the last 20 years, it's a topic of conversation with all of us, right, amongst our peers. It's basically the London IPO market's dead. We've lost 1,000 companies. We of 14 British biotech companies that have floated on the stock market since 2018, 11 of them have floated on NASDAQ. One of them floated in Amsterdam, and only 2 of them have floated in the UK. Big British companies like Arm Holdings, big silicon business, are choosing to go overseas. Britain has lost its equity culture in a huge way, and that's under Labour and the Tories. We've made a series of policy decisions over the best part of 3 decades that have been incredibly prejudicial to British equity culture. That's then compounded by my point about, most people don't learn about it, do it, think about it, have a stocks and shares ISA account. And the other thing, another thing that's driven it is the inexorable rise of passive versus active investing. And I find the sort of what I call the passive dogma brigade really annoying and quite ignorant, because basically the idea that passive, so if you invest in a tracker fund that's cheap, like a Vanguard S&P 500, and by the way, I think those things have merit to give normal people the opportunity to own 500 US shares or 100 shares in the FTSE very inexpensively in an ISA, and a tax haven like an ISA is a great thing. But the problem is passive investing. So John Bogle, who actually founded the company Vanguard and is kind of the father of passive investment, and a brilliant guy, but even he said that passive should never be more than about 15% of the stock market. And today it's more than 50% of the stock market. And the reason that matters, there are lots of reasons why that matters, but one of the main reasons is it cannibalizes away capital from smaller companies. Because if all of us are just going, I can invest 500 quid a month in my ISA, I'm going to put it into a Vanguard S&P 500 ETF. None of that capital is going to go into, company X coming out of Oxford University with a potential cure for breast cancer, or company Y coming out of Edinburgh University with some great software or AI or whatever else, right? So the inexorable rise of passive and billions and billions and billions of capital sort of unthinkingly going into passive, and various regulatory changes that have driven that, not just in the UK, all over the world, has been massively prejudicial to the capitalization and development of smaller companies. And then yet another nail in the coffin, by the way, is crypto, right? Because it's estimated about 9 million British adults have invested in crypto. And some surveys are finding that more British adults are now invested in crypto than in stocks and shares ISAs. Well, actually, if you so the 5% number I gave you earlier is about 3.5 million accounts out of 53 million British adults, or whatever it is. Those sort of numbers. So like 3 times more British adults are investing in crypto than are investing in stocks and shares, right? And whatever that, it's hard to know what the aggregate number of capital that is, but it's probably at least 10 billion quid. like there are estimates the average British person who has crypto has like 1,600 quid or £2,000, or but so it's of the order of sort of many billions of pounds. And that is another reason why small British companies have been incredibly challenged, because, you know, and I've lived and breathed this at the coalface because of working with biotech companies for the last 8 years. So a real company in the real economy that's got a medical device for, say, let's say cancer diagnosis from a simple blood test, which is a thing called liquid biopsy, is a revolutionary technology. It could strip billions of pounds of cost out of the NHS. They can't raise money because all the money's gone into passive, all the money's gone into, you know, doggy coin or Ethereum or whatever else. And whilst 10 billion quid in the context of like however many hundreds of billions the UK stock market is doesn't sound like much, it's super, super important for smaller companies where all the innovation comes from, and actually where most of the employment comes from and growth in Britain. So, you know, a whole series of sort of structural things have happened in the last, 30 years in terms of the silly decisions made with tax regime, with regulation. You know, it's just been death by 1,000 cuts into the UK stock market. And then more recently with crypto, with the rise of passive and everything else. But what it means is we've really challenged the British equity culture. And by the way, a lot of these things have impacted, you know, stock markets in Europe. There are relatively few that have escaped unscathed. And the ones that have are places like the States, Amsterdam and Singapore, where they've had just they have a much more capitalistic, equity-focused culture. But this is, you know, why is Britain in so much trouble right now? Truly, and this is what the tragedy is. So few people think about stock market investment. I sound like some weirdo. Oh, why is this relevant to the cost of living crisis, or the fact the NHS is in crisis and there are 7 million people waiting for an operation? It's absolutely relevant to it, because we're challenging our ability to innovate and, crucially, to create wealth that can pay the tax, that can give us the tax base for the government to be able to fund things like the NHS, right?
The first point around that, Andrew, has the temptation for us to become very political. And there's always that, keep finance and politics separate. But unfortunately, because of the policy that we've experienced over the last 30 and maybe arguably 50 years, politics is so relevant to the economic situation we're in because of the decisions that have been made in this kind of artificially low interest rates, all these different taxes, all these different levels of bureaucracy and red tape that has been introduced to the London equities market, which has made it so difficult for smaller companies to thrive.
Yeah.
And I think every time you and I have spoken previously, we feel largely politically homeless, because it's not a case of Conservative or Labour, because fiscally, if you look at the direction that they're taking all of our economies in, and if anyone believes that Sunak is fiscally conservative, then they probably came up the Clyde in the banana boat, as an older generation person in Glasgow would say. But it's incredible to watch this high tax, funny money, like really like pro quantitative easing environment, and think that it doesn't really matter whether, it might matter in the future whether Starmer or Sunak are in power at the moment, because really they've got a very similar approach to fiscal policy that is not going to serve us. And it's not just a case of blame these people or blame Liz Truss. Well, what they did has potentially inflicted harm. You're going back to Cameron, you're going back to Blair, you're going back to Brown, you're going back potentially even to the mid 90s under Major and Thatcher to some extent, based on where we're going from an economic perspective. And it is worrying that they haven't spoken about this, and again, you and I have joked before that there's either an element of stupidity or dishonesty when it comes to their public pronouncements about the economy. But I suppose you mentioned Jeremy Hunt there was maybe waking up to the idea that we might not be on the right tracks recently.
And actually, Rachel Reeves, that's the Shadow Chancellor, isn't it? It is Rachel Reeves. I think that's the right name. You know, that some of the stuff Labour's producing seems eminently quite sensible, actually, in terms of address. You know, British pension fund investment was 60% equities 15 years ago. It's now 19%, including global equities. It's only 4% of British pension funds that are in British shares. That's a complete disaster tragedy. That's why we're confronting all these problems. Honestly, it's hugely problematic. But here's a hair-raising stat for you, which, you know, anybody listening to this will think I'm some sort of mad, rabid conspiracy theorist. But actually, go and look it up, because it's, you know, what I'm about to say is true if you go and actually interrogate it and make some assumptions. So the British government, the percentage of the British economy that is the British state today, under the Tories, by the way, so the state, and if you honestly account for all the PFI stuff and all the government liabilities that are extant and put them back on balance sheet, if you honestly account for that, the British state is comfortably more than 100% of British GDP per annum, right? However, if you go down the rabbit hole on smart people doing smart analyses, the British state is more than 100% of the British economy, right? The communist state in the 1980s in Russia under communism was estimated to have been roughly around about 50% or so of the Russian economy, because the black market in Russia, basically the only way you could get bread or shoes or anything basically within reason was with recourse to the black market, right? The black market economy. So the black economy in Russia in the 80s was roughly 50% of GDP, implying that the communist government was roughly 50% of GDP. So today's economy in Britain is more than 100% of GDP. We have a higher state burden on the private sector in Britain today than the Russians did under communism in the 80s. So I've laboured the point rather, and what drives me nuts is that's a huge part of why we are living in such a problematic society and why things aren't going particularly well and inflation is high and everything else. But because so few people understand this stuff, most people want more. Like, most people think that, it makes me furious when people talk about austerity. Like, oh, George Osborne, what a horrible human being he was for imposing austerity on the UK. I don't recognise austerity when, in times where the government is relatively small, the private sector can innovate and develop technologically, and we get better economic growth. And actually, we also get much more equal outcome. The society is fundamentally more meritocratic, because now you live in a world of crony capitalism where the closer you are to government or investment banks that raise money for government or whatever else, the rich get richer and the poor get poorer. And society becomes less equal the more that you have state involvement. As North Korea is a pretty decent example of that in extremis, right? And yet,
it's a huge paradox, Andrew, for a lot of people to consider, though, because they genuinely do believe if the state has more taxation to spend on public services and to spend on helping the public, then of course the public end up with better outcomes. But that is fundamentally not the case. And this is something I've said to many people, and some listeners will know that I did a politics degree at University of Glasgow, and I used to argue with people quite continually about this in different seminars. And I was kind of viewed as almost anti-government, but I just want the smallest state possible to enable private companies to do their thing without the red tape to challenge it. And of course, there'll be bad actors that come along, and those will always be thrown up against you. I mean, we can look at maybe the pharmaceutical industry during the last couple of years in terms of some of the questionable things that have happened, but equally, overall, it's been a massive positive thing. Look at we're talking about infant mortality. We're talking about the fact that during operations, you can be opened up and kept alive on antibiotics for hours in order for things to happen, whether it's heart surgery or something else. But with the state being smaller, that's actually a good thing. Whereas, as you say, people are crying for more government intervention, more investment in things. And I do laugh you brought up George Osborne, because state spending grew during these periods.
That's it.
And people are saying, well, it was cuts. And I'm saying, well, like, we just need more money in these areas. Of course we do. But it can't necessarily always come from the state and from government. And I think if you look at the tax environment in the UK, and many people I've spoken to in the podcast who've become digital nomads and moved to different countries where they've been more, felt more like they've got control over their own money, that's a massive talent drain as well.
That's right. But we've got a massive talent drain. I've already explained how challenged our stock market is. I don't know what the tax freedom day is now, but it's like July or something. It's ridiculous, right? If you include VAT. So basically, you're working to pay for the government. Like, by the way, 19 million British adults don't pay any tax. So the relatively the few million people who do contribute tax, us horrible capitalistic folk, you're working whatever 6+ months a year to fund all of this stuff, which frankly is done really ineffectively. And actually, okay, fine, we've fallen down a political rabbit hole. Just to put some flesh on the bones and some thoughts, if you look at the last 2 centuries of comparative analysis of different polities that have chosen to have small government or large government, what conclusion does it help you draw, right? And so proponents of what we're saying. So if you're a small government libertarian and you believe that society is better, fairer, cleaner, I mean, in all seriousness, so compare Switzerland, to North Korea or Russia, right, where they just poisoned all of the seas, destroyed millions of hectares of arable land, all across the whole breadbasket of Russia. It's pretty clear that Switzerland is better than Russia or North Korea, in my opinion, right? Similarly, Singapore, like South Korea, like the tiger economies. Now, the counter-argument, which is often thrown at you if you say that, the comparative analysis, if you're contending that low tax, small government, libertarian policies and economic systems produce a better outcome for most, per capita income, growth, healthcare, everything is better. The big counter-argument is always Scandinavia. It's like, well, that's not true, because the happiest, richest people in the world are, although they have a high suicide rate, but overall, ironically, there's a dilemma there, because they have a high suicide rate, but on aggregate, they're happier. Like the Finns are generally the happiest people in the world. But
an element of extremes at either end.
Yeah, but Scandinavia is very held up as this kind of halcyon, socialist utopia of like tax rates really high, but you've got to pick a little bit behind why that is. So, firstly, the per capita resource endowment of Scandinavia is ridiculous in terms of timber and oil and zinc and copper. And, you go and look at what 8 million or whatever it is Swedes and 8 million Norwegians have per capita. I mean, Norwegian oil is a very good example. You'd have to be a nation of imbeciles to not have a very high per capita wealth. Norway gets all of its electricity from hydroelectric power, for example, right? How different that is to Britain. So basically all of its oil wealth can and has been deployed for the benefit of the Norwegian people, right? So you're comparing apples with apples. So they can afford a very, very high welfare state system where you have, admittedly, great education, great healthcare, whatever else. But then the other interesting sort of intellectual exercise is how much better would those societies have been if they hadn't had such an enormous welfare state, right? They've been wealthy enough to have a phenomenal welfare state. But actually, if you juxtapose the experience of Switzerland and Singapore since the end of the Second World War in terms of growth rates and progress, or various other sort of tiger economies, they've massively outperformed the Scandinavian economies in terms of growth and progress, right? And then the other thing to make, which is again slightly sort of politically incorrect, countries that remained neutral in the Second World War had a massive capital per capita advantage after 6 years of the rest of Europe being blown to pieces, right? Because if Sweden was able to sit there with basically none of its building damaged and all of its capital sitting in Swiss banks or in London accruing, not whereas Germany was completely decimated and France was decimated and London dealt with the Blitz. Funnily enough, their per capita wealth was starting at a rather higher base in 1945 than
there's a hangover off the back of that. That makes total sense, Andrew. And like I say, I'm very pro freedom. I'm very pro personal responsibility. Of course, I believe there should be an element of support from the state for those that are absolutely destitute and in need. But as you say, when the shackles come off, we actually create more and we generate more and we move society further forward at a pace which, as you've demonstrated with the stock market, even with lower percentiles of investment than we would like, it's moved the country in a massively better environment, and absolute poverty is considerably lower than it's ever been if you look across the board. The second point you were making was around passive versus active, and I want to say a very small piece in favor of passive investment, particularly for people that are just listening to podcasts like this one for the first time and maybe are trying to develop an investment habit, because it is a great start point for them to pick a fund that's cheap to invest in on Vanguard or HL or AG Bell, whoever it is, and get them started. But I completely understand that as you get older, wiser, potentially more experienced, of course you should open your eyes up to other opportunities. And I find it remarkable, as you said, that the founder of Vanguard, John Bogle, said that 15% is about right. But as you say, it's over 50%. So there's a massive delta between that. Yeah. And a lot of the people within that 40 odd percent are probably intellectually capable or have the time to be a little bit more explorative in terms of what they're choosing to invest in as well. And alongside that, it's quite telling that a lot of the companies that we invest in within these things, so if, for example, we are stock picking and we're not necessarily just picking S&P 500, we're probably picking things like Microsoft, Google, Apple, because they're household names. And just like you said, that is not investing back into companies that are potentially exploring things at a lower level or a newer level that are potentially bringing new solutions. And of course, we can say Microsoft's been fantastic, and the technology that I use to get to speak to you on calls like this, these are huge companies that are driving this. But if the ladder has been pulled up from these smaller companies because we're only investing in the FTSE 100 or the S&P 500, it will cut off the ability for people to become in that FTSE 100 in the UK in particular.
There's a massive free rider problem, right, as an economist would describe it, which is to be in the S&P 500, you have to be a really, really big liquid company, or in the FTSE 100, or even in the FTSE 250, right? That's I don't know what the entry point to the FTSE 250 is probably about 600 or 700 million market cap right now. So what if you're a 60 million market cap business doing something really cool, like in biotech or in software or whatever else, and that because it's become such a winner takes all world. And by the way, this is why the S&P has bounced again and is performing so well, because the trouble with, and I totally agree with the first comment you made, by the way, passive is it's a brilliant thing that if you've got 25 quid a month or 50 quid a month or 100 quid a month, you can end up the happy owner. If you buy the MSCI World Index, you end up with exposure to 1,600 stocks in the world, like all the world's biggest, best companies, right? But I actually think there's almost a sort of moral obligation, to your point. Like so start like that when you're a student or you're young or you're just starting your career and you're only just starting investment. But most older, wealthier people who are gainfully employed and making good amounts of money, who can perhaps maximize their ISA in the UK. So if you can save 20 grand a year in an ISA, or a husband and wife or a couple can save 40 grand, right, between them, that's a hell of a lot of investable capital every year for the lucky, wealthy, people who have pretty high paid jobs. And it's just a tragedy that so much of their capital will just go into an S&P 500 ETF, or because we are starving innovative, smaller companies for capital. And to my point, okay, so that's the kind of moral argument, which I can appreciate people say, well, why, screw that, I just want to get the best outcome at the best price, so I'm just going to carry on investing in the S&P 500, right? But then I'd refer you to what I said half an hour ago or whatever it is now, whereby UK smaller companies have returned 16.4% annualized for 66 years. If you want to really, really make a super normal return from stock market investment, you want to own Microsoft in 1980, not in 2020, right? Although again, we say, Apple have now a $3 trillion company, and you could have just sat there and gone, well, you don't want to buy it when it's already a $2 trillion company, right? Surely all the upsides behind it, and then it's a $3 trillion. But the reason that's happened is because of the inexorable rise of passive investing. And so here's a really important point. And I didn't know about this until a couple of years ago when I watched arguably one of the best finance podcasts I've ever watched, which was with a guy called, what's his name? Patrick O'Shaughnessy interviewing Michael Green. And Michael Green used to be the CIO of Peter Thiel's family office, Thiel Capital. So unbelievably smart guy. And he made the point that one of the several reasons that passive has grown so disproportionately and accrued, actually for under 40s in the US, passive's taken more than 100% of the capital of investable capital, because some people borrow money to invest. So it's actually more than 100% of capital. Active is saying less than 100%, like negative basically for a number of years. And the crazy, again, it's really sort of depressing when you hear this stuff. So because Vanguard and BlackRock, the two biggest passive ETF providers in the world, have so successfully lobbied the US Congress, US congressmen and senators, because they have, you think of arms dealers lobbying Congress and nasty pharmaceutical companies lobbying Congress. I'd never previously thought about big financial firms lobbying Congress, stupid me. But the reason, so basically they've made it, and a bunch of fairly financially illiterate congressmen, right, with really slick lobbyists coming from Vanguard and BlackRock saying, passive is always better. It's cheaper. It's a better outcome. So, and they've lobbied. They've been so successful that if you run a Fortune 500 company's pension provision in the United States, it's basically more than your job's worth to suggest that your thousands of employees allocate pension assets to anything other than a cheap passive investment fund. And that is really problematic, because the main problem with passive is it doesn't allocate capital based on valuation, right? if Snapchat is trading on 300 times PE in IPOs, billions of dollars will just have to flow into Snapchat because it's now in the index, right? Regardless of whether it's a good company or, you know, and it's this horrendous self-fulfilling upward spiral, which is why the S&P has gone bananas year after year, and every time it corrects, it then goes back to the moon, because all the algorithms and all the bots that are, and those billions and billions and billions of dollars that are going into passive investment, partly because they're a good product, but partly because, you know, some pretty nefarious lobbying has gone on both sides of the Atlantic, means that bigger companies get bigger because it's market cap weighted. So the bigger a company is, if you put $1 million into an S&P 500 ETF, it will predominantly be buying Apple, Facebook, Tesla, you know, Alphabet, not like the 497 through 500 smallest companies. And so
there's elements of crony capitalism again, Andrew, as you say, it just goes round and round and round. But as we said when we first discussed that point, there's certainly an argument. Start off with your passive investing, but as you start to become comfortable, please do explore other options within the market that might fit your interests, your needs, and even your potentially your returns as well.
And your ethical, I mean, there's an ethical angle here. Like, I mean, I, as a British national, I'm not investing at the moment, candidly, because everything's on black, because I'm an entrepreneur and I'm just doing my own thing with my company and paying myself peanuts until it, you know, works, right? But throughout the whole of the rest of my adult life, I mean, I'm 48 tomorrow, actually, as it happens, but all through my 20s and 30s and early 40s, I have invested. And there's a sense of being honor bound to kind of actually support innovation and young companies. And hopefully the upside justifies that over and above the kind of ethical thought process around. I mean, so my view is, if you want to keep things really simple, have an S&P 500 or an MSCI World ETF to capture that stuff easily and inexpensively, and then buy some smaller companies or some biotech or some, you know, whatever, and some actively managed smaller companies, because you basically, true smaller companies can't go into an ETF because they're too illiquid, and they need to, they're traded much more like kind of private companies almost. I mean, they're not, they're on the stock market, but you can't just, a machine can't just put an order in for like $100 million worth of a small company. A bunch of professional traders in the city and dealers have to go around trying to find the stock when you want to buy some of it. And, you know, this stuff is really poorly understood by politicians, by journalists, you know, a lot of mainstream journalists at least, and obviously by members of the public. But, you know, if we want a thriving ecosystem of innovative new companies, and that was the other point I was going to make, is this potentially is another reason why it might be a good time to think more about active investment, because very simply, like, you know, mean reversion, right? The pendulum has swung so far in favor of passive investing and crypto, which, you know, sucked $3 trillion out of the rest of the world at peak, right? Before coming back a long way from there, obviously. But, you know, the pendulum has swung so far in favor of passive investing, and everyone's investing passive, and all the pension funds are investing passive, and all the IFAs are doing passive, and active, by the way, is absolutely on its knees, right? And you can, you know, one of the leading mid-cap brokers, not even small-cap brokers, Numis, has been acquired by Deutsche Bank recently, and, you know, all these sorts of signals as to the fact that this is going on. Then might that mean that the higher probability outcome in the next 10, 20, 30 years for the rest of our lifetime might be that there's a trend back to active, because people like me are making this case? Because if we don't have a flourishing ecosystem of active investments, we don't have any future companies, because every single smart biotech company in the world is going to go bust because they can't raise enough money to do clinical trials. Or, you know, and by the way, this is very real. This is why, you know, of 14 British companies, biotech companies that have floated on the stock market in the last, since 2018, 12 of them have floated overseas. You know, and that's a tragedy, because it means their center of gravity, their staff, their, you know, clinical trials, all the economic value is now going to go to Boston and San Francisco, and not Oxford and Cambridge and Dundee and Edinburgh and Bath, right? Oh, sorry, that really did sound like something. I've been a bit ranty in this conversation. I apologise, but this stuff is really important. I think it's really, really important. At least, I believe it is.
It's a remarkable situation, as you say. And the pin that I put in the C word crypto was one that I knew we had to come back and unplug and revisit. And as you said, there's been such a huge amount of capital has gone into that space. And while many of the listeners will know that a portion of my investments are in the crypto space as well, I hadn't quite recognized what that meant for companies when it comes to wider employment, when it comes to wider human progress. Now, I feel that Bitcoin is a good investment personally for me because of the potential returns that I've got. But now I recognize, having had conversations with people like yourself, that Bitcoin isn't an employer. Bitcoin isn't necessarily changing the human progress other than potentially some financial changes that it might make based on the blockchain technology, based on it being potentially if we want to call it a digital gold in the future, whatever, depending how it all develops. But I do recognize and I do accept one of the major criticisms of it from people like yourself who have a really strong footing to do so, is that it's not employing people. It's not supporting British progress and jobs. And so with the market cap is all being diverted towards that, and something like 3 times the number of people investing in stocks and shares, ISAs, are investing in crypto, that is actually a challenge. And this is from somebody that hands up in the air. I'm quite bullish on particular aspects of the cryptocurrency market, but that is a massive downside if you look at what we're actually talking about here, which is investing in human progress.
Well, that's right. No altcoin project, right? No matter how it could be an amazing speculative investment and make you 800% because it's, no altcoin product or project is going to deliver £1 billion of costs taken out of the NHS because they've got a better medical device, right? That having been said, there are obviously Web 3.0. There are lots of projects around using blockchain technology to improve patient record keeping, and and I don't just want to dwell on healthcare, but I just think the real world use cases and social good of most altcoin or mainstream crypto projects is simply not as significant as the real world use cases of actual companies doing actual things. And so to me, certainly when crypto hit $3 trillion, as then borne out by Sam Bankman-Fried and all the stuff that's happened subsequently, that has directly cannibalized away real investment capital into companies that could be rolling back environmental degradation or revolutionizing agricultural productivity or improving how we generate clean power. I mean, truly, right? And that's just my view. And I absolutely don't decry that blockchain and this sort of disintermediation of the whole thrust of why crypto has potential utility and merit is definitely there. But I just think that this kind of flurry of investment into it in the last kind of 10 years or so has been really prejudicial to a bunch of companies that probably, if you take a step back, zoom out, like for humanity as a whole, that capital would have been better off in less speculative, more real world stuff that actually could have done a fair amount of good. Happily, hopefully, in aggregate, we're wealthy enough for there to be enough capital for everything. But I just think it's almost like we've got a ball and chain around our ankle at the moment, particularly in Britain, right? And maybe I feel
people get distracted though, Andrew, and I think because of the returns that were possible in crypto during late 2020 and most of 2021, a lot of people went across to it. And we spoke about the tragedy of people not investing, but there's a whole tranche of people that try to trade or swap or sell things that get burnt once and then never turn their hand to investing in other things. And you spoke about this in How to Own the World. To be a successful trader, you almost need to be full-time doing that and have years and years of experience, whereas so many people turn their hand towards that and they get absolutely mown down and then they never touch the stock market or some of the things that have worked over time, like equities, bonds, gold, real estate, whatever it is.
That's a big part of our mission, right? Is that so a lot of people, when they think about, so first it's the difference between investing and trading. We're all about investing, not about trading, right? And I think a lot of people, when they contemplate the stock market for the first time or financial market, capital markets, they think of it as a zero-sum game. They think that if for me to be a successful trader, I need to rip the eyes out of another trader, and that's how I make money. And which is a completely fallacious. This fails to understand the whole human progress point. Real companies doing real things like solving human needs and wants, right? Delivering real wealth. And so if you go into financial markets or capital markets or whatever with that whole mindset of zero sum, I'm going to be a trader, and if you think that way, it fails to recognize that the sort of that when I said earlier, the fact that capital markets are a killer app of modernity and underpin real improvement in the human condition. And that's a very bad place to come from philosophically. But kind of more prosaically, of more relevance to individuals is, investing in human progress should be for everyone, right? And it's really, I always use this, what we call the automotive analogy. Learning how to invest is no harder than learning how to drive a car. And I've said this ad nauseum, how many tens of hours or whatever it was you spent as a nervy, spotty teenager learning how to wrestle your way around a Ford Cortina or in my day, or whatever it was. Learning how to drive a car took that amount of time. To learn how to be a sensible investor and do something sensible by direct debit every month, and everything we talk about and everything that's in my book will take no more hours of your time than learning how to drive a car. It's just that 90 whatever % of people in Britain think it's perfectly normal to learn how to drive a car, and demonstrably 3 to 4% of people think it's sensible to learn how to drive your finances. I think that's a massive societal blind spot, because actually investing is probably a life skill that eclipses, especially in a world with Uber and Zip or whatever, not Zipcar, but Uber. Learning how to drive your finances is actually a better, more important life skill than learning how to drive a car, I think, right? Particularly as we live in an increasingly urbanized world. But and then trading, the problem is, people think, they finally wake up in their 20s or 30s or anything, I've got to get into this investing thing. And then they conflate trading with investing. And so they go straight past all the boring stuff that's worked for 200 years, like ISAs, stocks and shares ISO, the stock market, pension, whatever, into trading crypto or trading FX or spread betting, whatever. And as you say, the problem with that is, to be good at trading is probably at least an A-level's worth of knowledge, or maybe even a degree's worth of knowledge to really do it well. And the other thing is to do it on a properly risk-adjusted basis, so the absolute thousands or 10,000s of pounds a month you might aspire to make, you can do on a sensible risk-adjusted basis. You probably need many tens of thousands of pounds. If you've got a £2,000 trading account, you think you're going to make thousands of pounds a month. You're living, you're being egged on by somebody pretty dubious, because that's just ridiculous and it's not going to happen, right? So
that maybe stands to benefit from you investing as well through a course or through an affiliate deal. I completely understand that.
The rookie mistake, so many people, I've got £2,000, I'm going to spend 600 quid of it on a premium trading course, right? Well, no, wait, as boring as it sounds, do the proper stuff first and wait a few years before you start doing that. But actually the bigger tragedy, which I think is too seldom discussed, is the opportunity cost of all the time spent messing about trading. So the way that you become wealthiest in life is by becoming truly skillful, right? And then you'll be paid disproportionately well in your 40s, 50s, 60s, right? One of the tragedies about the whole explosion in crypto and trading and everything is the number of 20-somethings or 30-somethings spending hours and hours and hours and hours in Facebook chat groups and, on crypto WhatsApp channels and trying to trade crypto, figure out, do this today and do that with tiny amounts of capital, because that is candidly a waste of your life, right? As against learning what you enjoy doing, becoming better at it, becoming skilled. You're much more likely to be a millionaire if you, or comfortably, or whatever else you want to be, economically successful. If you find a job you love, work at it, become skilled, and become very valuable over a lifetime, right? From the age of, say, 20 to the age of 70, probabilistically, you're immeasurably more likely to be very wealthy as you get into your 40s, 50s, 60s by doing that than you earn by spending your 20s messing about trying to trade crypto. And if
you can become valuable to an employer, earn more income, become skilled, set up your own business in an area that you care about, and I'm sure we're going to touch on that for yourself, Andrew, as we go. As you say, your ability to put capital into the market changes as well. One of my favorite books of 2021 was Nick Maggiulli's Just Keep Buying, and he came on the show and we spoke about this, and he was like, so many people, if you're spending time researching what the best fund or coin or stock or anything is, perhaps if you invested that time into your day job, you would have more than £500 a month, you would have more than £300 a month, you would have more than £1,000 a month in the future to invest into the market. And that's what's really going to change things, because he was joking that even if you are in your kind of mid-20s, early 30s, and you're managing £500 a month away, fantastic. That's £6,000 a year. 10% of that, if you get that, is £600. You could earn that in a small bonus if you're good at your sales job, if you're good at your company, whatever it is you're doing. You're going to be able to generate far more income if you really index on the most important thing, which is how much money you're able to put in, and then of course invest it sensibly across the board.
And that's why I think it's really, again, to the driving point, learn how to invest. Set up something sensible automatically every month from when you're in your early 20s, if at all possible, and just leave that on autopilot. And like you say, get on with becoming better at your job. You're right. Making a £10,000 bonus because you were quite good at your job this year, or a much bigger bonus in certain industry sectors, is likely to be far more effective a way of making forward progress financially than making, super normal profits on trading crypto, which is highly unlikely to happen, right? Realistically. But that's again what we say in the last two chapters in my book are called Keeping It Simple and Taking Things Further. And the raw point is that, okay, but let's, with apologies to anybody who's 19 or 20 or whatever watching this, right? Because I sound like, but by the way, I'm 48 tomorrow, and goodness me, it feels like yesterday I was 19, as I'm sure anybody will tell you, and people who are older than me will tell you the same, right? Was that quote from that brilliant 1980s film, Ferris Bueller's Day Off, life moves pretty fast. You better stop and take a look around once in a while. You might miss it or whatever. Anyway, but rambling. But the point is that when you are 40 and you have tens of thousands of pounds, let's say, because you've done this in your 20s and 30s, that's the point at which you might take some of, or even you might be lucky and have a large six-figure sum, because you've done it really well and you've been a bit lucky and you've been maxing your ISA and making, investing in small caps and you made 15% for a few years or whatever. But it's at that age, it's the time to become really financially literate and try and complicate things a bit is when you're older with quite a lot of capital, truly. I think the hours spent in your 20s or even 30s trying to learn how to trade it really is time that's not very well spent. And I believe that because I've seen the havoc it can wreak on individuals, right? Like, because trading is almost, but basically becoming really into trading is not that far off gambling addiction. Let's be clear. And it's not investing, it's people who become addicted to betting on cricket or, fruit machines or, it's a very different thing philosophically to actually investing in human progress and innovation and science and technology. And I think there's much more social utility in investing than there is in trading, in my opinion.
One of the things that stands out about your story, particularly in recent years, Andrew, is that your investing throughout your youth and your 20s and your 30s has led to you having relative freedom to go and pursue something that you're truly passionate about in your 40s. And I think that's something that so many people that listen to a podcast like this one are quite excited by, that prospect. And there's an element of discipline equals freedom because, again, we've mentioned Damien already, and I absolutely love his content on YouTube, and he was a fantastic guest when we spoke, and you had a fantastic conversation when you were on his new podcast. He managed to get himself out of debt, totally change his life, and when he decided to leave a high-paying job to go all in on YouTube, he had enough of an emergency fund to last him for a period of time to give it a shot.
Yeah.
And if that's not an exciting story, because now, of course, the YouTube game's paid off. He's making more money, and every day he does something that he really loves doing. That's a fantastic position to be in. And I guess that's something that the positive element of everything that you write about and you share, and as I say, your emails in recent years have been a really positive anecdote to some of the challenges that we're seeing. That is a message that so many young people want to hear because they're like, right, okay, maybe I can purchase this freedom to go and pursue something that's more in alignment with my future.
Well, that was so when I did that podcast with him, the Making Money podcast he does with his mate Tim, that was such an uplifting thing for me. He sat across the desk from me and said, "Listen, I read your book X years ago, and it worked for me. Like I spent my 20s, like you said, he was in debt in his late teens, early 20s, and he learned about sensible monthly investment by direct debit into stock market assets. Did it through his 20s, and got himself into a position where he could, pardon my French, but he had FU money, right? As you can turn around to your boss and say, hey, listen, I don't need to take this shit anymore. I'm going to go and spend a year, 2, 3 years, whatever. And I've been able to do that. I mean, I've spent, it's 7 years. So since leaving uni, I've funded myself for 7 years I left uni at 21. I'm 48 tomorrow. Like 7 of those years, I've been able to take a step back, do something entrepreneurial, have a go at something, make a change, travel, or whatever. But now, admittedly, I did do quite a highly paid career. I worked in financial services, and I fully grant that. But Damien's a good example. With a reasonably good, solid job, as long as you don't have lifestyle creep, don't go and buy a Porsche if you can only just about afford a Porsche. I wrote this, I think, in my second book about how, basically my costs today, apart from the fact I've got 2 kids, are not really that dissimilar from what they were when I was in my 20s, like in terms of groceries, clothes, whatever else, right? And so the difference if you've made career progress and you're being paid more, is super normal stuff you can invest, right? And then you can make money on the money that you've invested. And too many people, get a pay rise and then spend it all on a more glamorous holiday, right? Or whatever else. And by the way, I think part of the reason people do that, part of the reason people are bad at saving and investing, is because they're afraid of it. And they're like, they don't know what to do. It's like, well, if I've got some extra money this month, I don't know about that, and it's intimidating, and I can't be bothered, and so I'll just spend it, on holiday or going out more or whatever. And but you want to be Damien. You want to be there at 30 whatever years old with the freedom to go and do whatever it is you want to do. And but again, the caveat to that is, as he said and as we discussed, is it took him 10 years. And unfortunately, people are very, very impatient. But I mean, the beauty of things taking 10 years, as I said earlier, is 10 years goes by very quickly. Like, from the vantage point
Andrew.
of, when you're 30,
you've been at the
sorry, go on.
You've been at the forefront of life science companies, biotech, for 10 years now, and now you're going down your own route in that space. What makes you so passionate about that space in particular? You've spoken about technology was the driver of the last 100 years. What makes you so passionate about your upcoming book and the work that you're doing in that field?
So, well, look, I mean, as I said earlier, you create economic value from solving intractable problems. So, we need, the agriculture industry came about because we needed to feed ourselves. The property, real estate industry and architecture industries came about because we needed to build buildings. The aviation industry and shipping industries and automotive industries came about because we wanted to move ourselves and goods around the world, right? So real value, true economic value is created by delivering. That's what's so great about capitalism, right? Is that actually all that money is, or financial return is evidence that we've improved our situation in terms of, and I often talk about, like in a race between, we're in a race between kind of Mad Max and Star Trek, right? Mad Max, post-apocalyptic disaster, Star Trek, where everyone's wealthy. And in that, our job as a species is basically to sort of transmute the periodic table to make everybody happier, wealthier, longer lived, healthier. And that's what we've been doing since we invented chemistry and tech and everything else. The reason that I'm so excited about biotech is because most of the remaining problems we face, so that is, we've got a serious environmental degradation problem. The oceans are poisoned. We've got heavy metals and inorganic and organic compounds have leached into our agricultural soils. We're destroying the rainforest. We need to cure cancer. We don't want sickness and infirmity. We need to improve health span. We need to do a much better job with clean power generation. And it is truly the intersection of tech and biotech which is going to address all of those things that I just said, whether it's curing disease, intractable disease, or revolutionizing clean power generation, or it's going to come from biotech, because these are problems of biological systems and biology. So that's why I'm really excited about it, right? It's
one of the things that I'm excited to see in your upcoming book is around the focus on chronic disease, in particular around gut microbiome and stuff like that as well. And I know that you had Crohn's as a younger man, and you're quite passionate about what's going on inside the gut, because it's an extremely complicated topic and something that so many people struggle with. Because if you look at the mental health epidemic, a lot of people that really know their stuff realize that the gut is the second brain, and if your gut is having challenges, best believe your brain's going to have some challenges off the back of that as well. So what is it around gut microbiome and that makes you so excited and what you code into?
It's much bigger than that. I mean, that's gut and psychology syndrome gaps. You know, you're right. It's basically, it's also where a huge proportion of your immune system resides. But yeah, so I go through this in real detail in my new book, which is sadly not going to be out until probably early next year at this rate, but we'll see how we go. But it's called Our Future is Biotech, and that is, it's really fascinating. So in the last century, basically since we started synthesizing small molecule drugs in kind of like the 1880s, really, a number of German chemical companies like Bayer and others started doing that. And then penicillin in the 40s and. But basically, we have been successful in dealing with infectious disease, right? So infant mortality's fallen. You know, like in 1900, vast numbers of people carried off by dysentery, and smallpox has been dealt with. And so now in America, so that's basically happened. I want to get into vaccine conspiracy theories, but basically, anti-infectives, antibiotics, starting with penicillin in the early 40s or mid 40s, and then vaccines. And those two technologies have saved billions of human lives. You couldn't have surgery without antibiotics. So imagine a world without surgery, without anesthetics, without all the things that we now take for granted because of hedonic adjustment, right? But the trouble is, whilst we've triumphed over infectious disease because of those two broad technologies, at the same time, there's been a massive rise in what are sometimes called diseases of modernity or modern plagues. So that is mental health problems, ADHD, trauma, PTSD, post-traumatic stress disorder,
Autism,
generalized anxiety, autism, diabetes, obesity. There's a whole raft of autoimmune disease, Crohn's disease, IBD. So what's going on, right? How is it that we've had a century or more of massively succeeding in vanquishing infectious disease, but the sort of flip side of that is diabetes and autism are like a multiple more prevalent in the population today, and obesity. Now, it's not because everyone's eating too much, actually, and this is increasingly being established. It's because of the role of microbes. And the relationship that we've changed our relationship with the microbial world in the century or so since we started developing drugs and agriculture and everything else. And this is what's so exciting. Is another very exciting frontier of biotech is, so put it this way, the biomass of all bacteria in the world is more than 1,000 times the biomass of all human beings and mammals. So that's how important they are biologically and in terms of life on Earth, right? And so because the evidence is increasingly that basically if you compromise the bacteria within us in terms of your gut microbiome, and actually without us in terms of what's out in the environment around us, in our soils and in our buildings and in our pets, if you significantly alter the balance of that incredibly complicated microbial world, but it's bacteria, it's viruses, it's archaea, it's everything else, right? But it's 1,000 times us in terms of biomass. You then get these prejudicial outcomes because you're right. Dysbiosis is basically where your microbiome in your gut predominantly, but also on your skin and elsewhere in your body, but the bacterial balance in you is compromised such that you will start to get health conditions. It's indicated for cancer, for everything we've just talked about, right? And so that seems to me is a very plausible thesis. In the last century, we've beaten infectious disease, but in doing so, we filled the planet and our world and our agricultural, our rivers and streams and seas with antibiotics and heavy metal leaching out of the soils and everything else. And that has altered the microbial world such that it's being very prejudicial to our health, right? And the food we eat and everything else. But what's really exciting is only in the last 5 years or so do we have the technologies not only to understand that, which is basically a thing called an NGS, a next generation sequencer, and big data, AI, machine learning to interrogate data sets that are exabytes in size, like just, billions and billions, to go in and answer, okay, well, it's like, do you remember the first Batman film? Or maybe it was the second Batman film where I think Michael Keaton's Batman character figured out how the Joker was poisoning the citizens of Gotham City. And it was an incredibly complex, sorry, it's a very spurious example, but is this incredibly complicated, multifactorial relationship between hundreds of millions of different bacterial organisms and genes and whatever else. But we finally have the computing power and the technologies to begin to understand it. And crucially, through a thing called CRISPR, which was a Nobel Prize winning technology in 2020, gene editing technology, we might start being able to fix it. So we'll be able to understand it and fix it. And so what that means is we're going to be able to have our cake and eat it. We're going to be able to have vanquished infectious disease and sort out our agricultural productivity, improve the nutritional value of our food, and vanquish obesity, autism, diabetes, everything else. Because, so obesity, for example, like if you have dysbiosis, if your gut flora is compromised, no matter how well you eat or how healthy you are, you're not assimilating the nutrients properly. So you'll still be hungry. So you'll still eat. So, and these are, to me, these are great. I like to think that this new book is full of an awful lot of stuff that isn't yet in the contemporary zeitgeist, but hopefully will be.
And also the exciting part, and we've shared that technology moves so quickly, you would hope that your book is almost out of date in a number of years because of the nature of the pace of change. And if the investment goes into the right companies and those companies find the right solutions, then what you're writing about will be a very short-term prediction, but hopefully even shorter than
so predictive, but that's right. But like my first book was pretty evergreen stuff. What are financial markets going back to? There was the technology of the stock market and bond market and commodities and gold. These are things that have been around for hundreds of years. This is a bit less like that, but it tends to be quite evergreen in terms of just the big picture impact of just this kind of new science on all of us. And actually, that having been said, part of the reason it's been a really brutal 18 months trying to get it done was because of look behind me, right? Pretentious, obligatory bookshelf. But the bibliography's got something like 95 books in it. And I kept going, I really need to read this one because I've been, going down the rabbit hole on all these different things before I could then finish a chapter on that stuff. And at some point, my publisher, had to stamp on me and say, stop, happily. Otherwise, I'd be going mad by now, to be honest.
Over the last couple of years, though, you've definitely been pursuing something that you truly care about, and it's a venture that you've got so much purpose for and so much energy for. Look at the way that you talk about it. But importantly, during one of our discussions just there, you actually mentioned that you aren't investing at the moment because as an entrepreneur, you're putting your money into that particular space.
Yeah.
What would you say from a financial perspective people need to bear in mind when it comes to entrepreneurship and potentially trying to build something on your own?
Well, yeah, I treated this in some of the stuff I've written over the years, but kind of like, basically everyone should figure out to optimally invest in their ISA and their pension, right? And one of the ideas as a British national, one of the ideas I always talk about is 100 minus your age, which is a really, really elegant idea, which is basically like subtract your age from 100 and it will give you the rough percentage of your investing each month that you should put into aggressive versus defensive assets. So if you're 30, you should be 70% aggressive, 30% defensive. And if you're 70, you should be 30% defensive and 70% aggressive. And that's just a really, really elegant way of treating the fact that, let's say you're 30 and you've got 10 grand and there's a stock market crash and you're 100% invested in the stock market and now you've got 5 grand. That's annoying, but you've got like decades left before you want to retire to sort it out and benefit from the supernormal returns of the stock market. But if you're 60, you've got £1 million and it's all in the stock market and there's a 50% correction, you've got 500 grand. That's a very, very different problem, right? So that kind of that broad approach is how we kind of disaggregate that sort of stuff. But the only exception to that, to your point, is if you want to be an entrepreneur and you're thinking, I need to save up, I'm going to need to cover like 2 or 3 years of my own like running expenses in order to do something entrepreneurial, you should probably just be a little bit more considered in how defensive you are, because what you don't want to do is save all through your 20s, aspire to quit for a while in your 30s to do something and find that you happen to do that just on the point of a stock market crash, which again maybe you saved 20 grand, there's a stock market crash and now you've got 12 grand. It's a bit annoying if you're getting to a point where you want to take a few months off, right? But that's all a pretty, and because the other point about that is how you distinguish between using a pension and an ISA, because obviously everything you put into a pension you basically can't touch until you can first legally retire. So you need to do that it's a very good thing to do because of the tax benefits. And one of the other points we make is if you have an employer that is allocating money into a pension for you and a generous employer who will match your contributions, that's probably a very sensible thing to do, is to max what you put into pension that they'll match, because you've immediately made 100% return.
Free money. Yeah,
exactly. And crucially, a 100% return, right? You get, where else you get a guaranteed 100? If I put a grand in, they put a grand in, that's a 100% return on day one. Like that. So, but if you are, look, in a perfect world, if you can calibrate your life to do the pension with your employer, unless you're an entrepreneur already, and then it gets a bit more complicated, obviously. But for most people, pension with your employer, ISA on your own steam, stocks and shares ISA, for instance, sensible stuff. And then if you want to be an entrepreneur, just make sure that there's a bit more that you're accruing over many, many years. But you don't need to be too prescriptive about it. At the end of the day, if you're saving and investing 10 or more % of what you earn every month, and you're doing something sensible with it, through all your, from the moment you can afford to for the rest of your life, it just maximizes the chance that if at some point in your life you're like, oh, I actually really fancy pursuing that idea and having a crack at it, you're going to be able to, rather than going, oh, I've spent everything I earn every month for the whole of my adult life and I'm stuck,
Agreed, Andrew. And one of the interesting things you shared with me as a framework for having purpose and alignment was around the 12-year-old self and £1 billion. Can you share that with the listeners as well? Because I think they'll find that useful.
I can't remember where it came from. It will be somebody like Mark Andreessen, the guy who founded Andreessen Horowitz and Netscape. Or Peter Thiel, or some amazing American billionaire VC. And I do love this because it's like me talking my own book in the dark moments that we all encounter as entrepreneurs, and there are plenty of those, right? It's a tough road being an entrepreneur, but two questions. If you want to think about whether you're doing the right thing with your life, like big picture, employment, whatever else, there are two questions you can ask yourself, which give you a sort of prism through which to consider whether you are. And the first is, what did you really want to do when you were 12? Like 12, so not when you were 8, because if you're a boy, you wanted to be a fireman or a race car driver or a jet pilot or spaceman or whatever. Like if you're a 6-7-year-old boy, then obviously girls, some of them would like to do that too, and some girls would have liked to be something else. And if you ask my daughter, it would be a princess, fairy, unicorn, obviously. But my point is that by the time you're sort of getting towards being a sentient adult and forming up your ideas, but you're still young and naive is not the right word, but if you asked me when I was 12 what I wanted to be when I grow up, the answer would have been a writer, right? I used to write all these little fantasy stories, and and I loved it. I'd bang away on my mum's typewriter, and I really dreamt about one day being a writer. And then the other question is, if somebody gave you £1 billion or dollars or euros tomorrow, if somebody if you were wealthy, if you inherited $1 billion from somebody randomly, what would you do with the rest of your life? Because with $1 billion, you could you could spend whatever you want on a handful of properties and all the toys, or not if you're slightly more sensible. But you can basically cover it for life. So with the other 9 billion, 900 million, whatever, what would you do? And my answer to that, if I look at myself in the mirror, is I would try and revolutionize the funding of small innovative companies, primarily in the life sciences market, because they're seriously challenged, right? And if I had £1 billion, I could do massive good with that. And so it's quite pleasing that I find myself kind of through luck rather than judgment doing those two things. Because when although sadly not with $1 billion, let's be clear, but when I first heard that idea on some podcast somewhere, I was having had a really tough few months, like writing the new book, and I thought it just made me smile, because I was like, when I was 12, I wanted to be a writer, and if you gave me $1 billion, I'd try and revolutionise funding of small European stock market listed life sciences companies, and that's what I'm trying.
That's the path you're on, which is it's so exciting, and particularly on those dark days, it gives you the chance to be like, look, I'm in alignment with myself. And there's a phrase that I've heard a few times, that the tools will be heavy, but they'll feel lighter in your hands. Whereas if you put those tools in somebody else's hands, they would feel the same weight that they are to everyone else, because they're not the same. They're not driven by the same mission. They're not on the same path. They're not on the same level of purposeful alignment, Andrew. And I'm so excited to see this new book come to fruition.
Thank you.
I've got so much time and respect for what you've built, and I'm so grateful for your time today. And I'm excited to hear what the audience think as well. Where would you like to direct them towards to continue the conversation with you?
Well, so very simply, our website is plainenglishfinance.com. So It kind of does what it says on the tin, or plainenglishfinance.co.uk. They both work. And on there, you can subscribe. We have a free email list, and I only email. I mean, actually, I've hardly emailed. I haven't emailed anything since January, and I'm about to do one in July to give you an idea, right? But my normal cadence for the last 6 or 7 years is probably an average about one email a month. And they tend to be relatively long form and sort of, people tell me they appreciate them because we try and sort of unpack and explain something in detail so that people can actually do something with it, rather than, it seems to be so many email lists I'm on are like 3 fairly useless short emails every week that they bombard you with and you delete every time. Our email list is not like that. So yeah, come and find our website and chuck your email address in there. And then, as I say, I'm about to send this email on hopefully this week called Pessimists Sound Smart, Optimists Make Money. And that's going to be followed in the weeks ahead with an awful lot of elucidation of everything that we've just talked about over the last hour and a half. So
agreed, Andrew. And like I say, I've found the emails extremely helpful over the last few years to get an idea both of the direction of travel when it comes to the economic environment, but also where things are going when it comes to things like biotech. And of course, if you're on that email list, you'll be one of the first to know when your new book's going to be available as well. And that'll be linked in the show notes. So thank you very much to you, Andrew. And thank you to you, the listener. I'll be back to speak to you all again very, very soon.